Residential sales comparison and income approaches, page 77. However, if relevant comparable data is non-existent or scarce, appraisers can sometimes isolate adjustments for certain property rights differences. But the process can be complex and may require a greater degree of competency that is usually possessed by many residential appraisers. Examples of possible adjustments might be for differences in a leased fee estate, which can sometimes be addressed using an income approach. Adjustments for certain property limitations, such as an easement, can be identified through paired data analysis and applied to the comparable data as a percentage adjustment. 2. Financing terms. The purpose of applying adjustments for special or non-market financing terms is to bring the comparable data to cash equivalency. Sometimes this adjustment can also reflect items that could be considered conditions of sale. Financing terms could also be broken down into separate adjustments for the method of financing, such as seller financing and costs paid by the seller related to financing, such as the payment of discount points. A discount point is an amount paid to a lender when a loan is made to make up the difference between the current market interest rate and the rate a lender gives a borrower on a note. Discount points increase a lender's yield on a note, allowing the lender to give a borrower a lower interest rate. Each discount point equals 1% of the loan amount. Following is a very simple example of how an adjustment might be calculated by discounting when the property is financed at a below market interest rate. For example, the purchaser is buying a $120,000 home with a down payment of $20,000, with the seller offering to carry the $100,000 balance at 5% interest for a 20-year term. That mortgage has a payment of $536.82. Current market interest rates for a 20-year mortgage are 7%, which would have resulted in a payment of $665.30 on the $100,000 principal. Thus, the cash equivalency calculation is as follows: $665.30 minus $536.82 equals $128.48 savings per month. The monthly savings, discounted at a market interest rate of 7% over the 20-year term, has a present value of $16,571.67. Present value calculations will be illustrated in Chapter 4. The cash equivalent sale price is $103,428.33. $83,428.33. $100,000 minus $16,571.67. Plus $20,000 down payment equals $103,428.33. Important considerations when using this calculation are that the seller interest rate and the market interest rate would remain consistent throughout the entire life of the loan, and that homes in the market area are typically held for the full 20-year term. The present value calculation should always reflect the typical holding period. The same formula can be employed for loan assumptions. Discount points definition was highlighted in this section. So remember, a discount point is an amount paid to a lender when a loan is made to make up the difference between the current market interest rate and the rate a lender gives a borrower on a note. Discount points increase a lender's yield on a note, allowing the lender to give a borrower a lower interest rate. Each discount point equals 1% of the loan amount. 1% you can. Test question. Property paid $200,000, bought down 2.5 discount points. $150K, something about $3,750. Know that. Least fee comps. 600,000 species of mold. 9 of them are deadly.